strategist at CLSA. Napier is one of the best big-picture strategists whose solid ground report has been providing investment advice to professional investors for almost 2 decades now. So he joins us on the phone line from Scotland to make sense of all the global mayhem that we've seen in the last couple of days. Russell, hi, good afternoon, and thank you so much for joining us on the show. This mayhem was put into motion after China devalued the yuan in the first week of August. Do you think that global markets have priced in the possibility of a slower growing China, or do you think there's more to go on the downside?
No, I think there's significantly more to go. China is faced with still an exchange rate target. They are intervening. They have an external deficit, and they want to ease interest rates. These three things are entirely incompatible. One of them will have to give. The most likely one to give is the exchange rate. And therefore, what looks like a very major reaction in markets to a very small move in the exchange rate is really a small tremor in preparation for a much larger movement in the exchange rate. And if that is to come, as I believe, then there is significant further downside for the outlook for global growth and the outlook for deflation rather than inflation, and perhaps most crucially, a fear that central bankers can't reflate the global economy. And so, therefore, the movements we've seen seem entirely warranted to date, and I think there's much more to come.
Okay. Russell, hi. Good to have you on the show. From China, do you expect some more moves on the currency front, or do you think this is pretty much it?
No, there's more to come. The key indicator we need to look for in China is actually their interest rates. The monetary policy is too tight. Real interest rates are too high. The economy is not growing. They need to bring down nominal rates. They need to bring down real rates. They are not succeeding, and that's the crucial thing. That is not succeeding in reflating the economy. We've had several interest rate cuts, RRR cuts. It isn't working. And if it doesn't work, then they have to go to Plan B. And Plan B will be to take the interest rates and print enough money to create the reflation. But you cannot expect the exchange rate to remain stable if they aggressively go towards other forms of inflation. And therefore, as long as you believe that ultimately China will be aggressively pursuing reflation, which I think is a very, very probable, then you have to believe that the exchange rate is likely to fall significantly further.
Okay. So since you believe that there is significant downside, or there could be significant downside because of the Chinese problems, would you advise a cash preservation at this point in time, or should investors across the globe continue to deploy money at lower levels?
No, I would advise cash, particularly for retail investors. Retail investors need to know that they have huge advantages over professional investors because they have the advantage of doing nothing, whereas most professional investors are paid to do something. And there are times in life when doing nothing is a good idea. Warren Buffett famously said that investors need to wait for the fat pitch, baseball term reflecting you waiting for the easy ball to come. And that's what investors should be doing. You should be waiting and doing nothing. If I can quote from Adam Smith, the great Scottish economist, he said the greatest cause of distress amongst men of wealth is feeling that they have to do something. And sometimes doing nothing is good advice, and I think that's where we are today.
Okay. Any pitch where easy balls are available right now, Russell, in terms of either either equities or fixed income? Any market which you believe has become very attractive after the kind of fall that we have seen?
Well, the one I single out is Japan. I'm talking here about the failure of central bankers to reflate. The one, and Japan has shown no more particular success than any others, but I think we can bet on them to be much, much more aggressive going forward, and ultimately the yen to go much, much lower. I would still advise sitting on your hands in the short run, but if we ever get to the stage where the yen starts to fall more rapidly, then it's time to be buying Japanese equities. It's difficult for the retail investor to hedge currencies, but hedging the currency would be very wise. Or there may be investment products available where that is done for you, where you're long Japanese equities, but you have a hedge, and into the United States dollar should be fine for Indian investors. So I would partially pick out Japanese equities, but apart from that, it is time to be very, very safe. And if you are in fixed interest investments, to be very much at the long end of the curve, because there may be further upside.
In fact, I was coming to that. We have seen the U.S. bond yield, reflect the rush to safe havens at least in the last couple of days. Do you see fixed income get more attractive than equities in the next, 3 to 6 months?
The answer to that is yes. The Treasury has been particularly remarkable. We don't know how much Treasuries have been sold by the PBOC. but it's fair to say that it's probably in the hundreds of billions of US dollars just since the move in the exchange rate. Now, that yield has come down against the background of the world's second largest owner, the PBOC, liquidating its treasury position. It gives you some idea of the scale of private sector demand for treasuries, given the scale of that public sector liquidation. So let's say we do move the exchange rate, that China moves the exchange rate. The PBOC is no longer a liquidator of treasuries. Also, China's moving the exchange rate means it's going to be selling things a lot cheaper in dollar terms. There could be a huge pressure on the dollar and also on the United States Treasury market if China finally makes that move. It's the resilience of the bond yield, given the scale of PBOC liquidation, suggests that when the PBOC stops, then there's still significant upside on the Treasury.
Okay. Russell, what's damaged sentiment in equity markets in emerging markets is really what happened with the US market over the last 10 days or so. So two-part question. A, do you think US market right now can go further lower from here? And two, is the US market at the risk of starting a bear market, which could have its significance or impact on the other emerging markets as well, or other equity markets as well?
Yeah, I think the flow in this is from emerging markets into the United States of America. But it does cause major issues for the United States. For instance, there is a Treasury inflation-protected security market for just 1 year. And that is pricing in inflation this morning of minus 1.6% over the next 1 year. U.S. equities, and I look at a thing called the cyclically adjusted PE, we have data on that back to 1881. U.S. equities are as expensive as they had been in 1929 and 1995 to 2000, and otherwise they have been more expensive. Now, there is nothing in the historical record to suggest that equity valuations in the United States can remain as incredibly high as that if you actually get deflation. So I think there's significant room for economic downside in the United States, downside on equity valuations in the United States of America, albeit that at this stage the flow in terms of deflation is from emerging markets into the United States. But back to that key issue, we have lived for nearly 6 years now with a belief that our central bankers can create higher nominal GDP growth and solve the excessive debt problems of the world. And what we're witnessing, I think, began with a move in the Swiss franc, is now happening with the move in the RMB, is that failure. And if equity markets come to believe that central bankers can't achieve this, then there is very significant downside. So that would obviously feed out of the second part of your question into the rest of the world, because this would not be an isolated United States phenomenon. If we lose faith in central bankers to create inflation and growth, then I'm afraid it's a global bear market, not a localized bear market.
Okay, that point is very well taken, because, sitting here in India, it becomes very hard for us to judge what the situation in China is and how it's evolving. But so far, Beijing has pumped in about $140 billion into the markets to sort of prop up the stock markets, but that hasn't helped much. How high is the fear of a hard landing in China? And do you think that the situation now that we're facing is much worse than what we've seen in, say, 2008?
Yeah, my fear is not of a hard landing in China. My fear is of a devaluation. We have to remember that devaluation is paving the way for another major reflation in China. Whether it's a good reflation or a bad reflation, time will tell, but it will be a reflation. It's the exchange rate we have to worry about, because although it may be a buffer for the Chinese economy and make things easier in China, it just passes those problems out into the rest of the world. I think your listeners should, or your viewers should perhaps read or look at a fantastic interview with Rajan, which was with the BBC yesterday, when he said central banks are failing. Not only did he say that they're failing, he said that more action from here could make things worse rather than better. And to hear that from not just any central banker, but from a central banker with such a great track record, I think is quite alarming. And the markets seem to have ignored that. But it's not just me phoning you from Scotland to say that central banks are failing. Even your own central banker is pointing out to the developed world that they're not succeeding. Markets, in my opinion, have not yet fully discounted this central bank failure.
That's a great point, Russell. Always good to hear about our central banker. He also said that there's too much pressure on central banks right now, and there's only limited weapons in their arsenal. Do you think we're reaching a stage where the central banks would run out of ammunition, and that could lead to a bit of a cascading impact in asset markets?
Yes, and they already have run out of ammunition, because what they're doing isn't working. Just back to that quite alarming United States figure, let's go out the curve a little bit and look at the 5-year TIPS market. Currently indicating inflation averaging just over 1%, or I think it's 1.2% now over 5 years. This is in year 6 of quantitative easing. This is an expected inflation rate, which isn't really that different from where we were in 2010. So the markets, I believe, are screaming that quantitative easing isn't working. They are out of ammunition. Now, that's why you can see indicated the U.S. stock market down 1,000 points, because if it doesn't work, what comes next? I've got greater fears on what comes next. It's not going to be monetary policy. There's going to be more direct government interference in the allocation of credit, the allocation of capital, perhaps under the guise of macro-prudential regulation. You might want to call it capitalism with Chinese characteristics. But because our central bankers feel doesn't mean that they are authorities concede defeat. They come back with government action and government reaction. So the baton is now being passed from central banks to governments, and I cannot see how that passing of that baton can be good for return on capital, or in some cases, return of capital.
Okay. Well, finally, before we let you go, you started off by saying that there could be significant downside. But for the Indian markets, we've relatively been a safer haven compared to other emerging markets. Do you think that relative outperformance will continue, or do you think that, it's going to be one swift move taking all markets downside in the next, say, 6 months or so?
Yeah, I can see the economy being in a better position. Generally, the Indian economy can benefit from some of the disinflationary things going on in the world. But it's very different to say that that is also true for the stock market. What should be happening, given the decline we have seen in some emerging market exchange rates, given the decline we've seen in the oil price, which is key for some emerging markets, we should see a major default in emerging markets. Now, it's unfortunate for India, as it is for most other places that run better, more reasonable economic policy, that we tend to get sudden stops to emerging markets as a group, as an asset class. I mean, it is a form of madness, this way we have of grouping capital into little ghettos. And there's an emerging market ghetto for capital. And I'm afraid when it stops flowing to one, history shows in 1982 and 1987, and in 2008, it tends to stop flowing to all of them. So I'm afraid India gets caught in that downdraft. But I do believe that the economy is in a much better situation to deal with that downdraft than many, many other emerging market economies. So I'd still be wary on Indian equities, but always optimistic that the economy is in a better situation to deal with this than most people in emerging markets.
All right, Russell, we'll leave it at that. Thank you. I think that caution will be taken with both hands because the market is getting very exuberant today. That's Russell Napier saying that if the central bank governor, Raghuram Rajan, says that global central banks are failing, that's when you should start to get nervous. And he says that this is the best time to preserve cash. But that doesn't look like the situation in our own markets.